Good afternoon. I was about to say good evening. That's what it feels like for me. But good afternoon, ladies and gentlemen, and welcome to this week's trade review session. So it's been an awkward week for me, a difficult week. I top and tailed the week with losses on Monday and losses again today. Markets are still quite volatile at this particular time. The Dow and the Dow is trading towards its high since the opening bell. We've traded just above that 27,000 level. 26,700 level. I must apologise. I have a very close relative who's in the hospital having an operation today, so I'm not entirely sure that my head is completely in the right place all of the time. But you can see that we've traded back up towards 26,700 after being down to 26,400 earlier in the day. So it's another volatile session. When you start to see a bit of flow into this market, it is quite fragile. Obviously, yesterday we saw or started to see some positive news in relation to the COVID payments in the United States, or the COVID stimulus that's been halted for a while. And again today we see some speculation in relation to that in the way that the markets are trading. So when it doesn't look like it's going to happen, we sell off, and when it does, we start to rally. In the background, obviously, we still have vaccine type related stories. The election is getting ever closer. In November is the date for that. And of course, we still see a lot of twists and turns in relation to coronavirus. More notably in Europe than in the United States at the moment. I don't see quite so many reports in relation to what's going on in the US. But in the US and where I live in Ireland, there are definitely more instances of increasing or reintroducing the lockdown measures. So I think the market is going to remain volatile for the next couple of weeks, most certainly while we see these stories play out, and we see where we go from there. As I want to do over these particular periods, what I do is I often focus on the negatives, and obviously, as I've already mentioned, with a week that includes a losing start to the week and a losing end to the week, again, it will be no surprise that I'm focusing on the negative. So there's a couple of we'll talk about Monday and Tuesday in a little bit more detail when we're looking at the results page. Just in relation to yesterday, I had 12 winning trades in a row yesterday. I was quite content at that particular point and didn't really anticipate forcing it much more than there. But I did do a 13th trade, and that trade was just before the jobless claims number came out in the United States. So it's in this particular area where you see the crosshairs at the moment. And my belief, as it was at the beginning of the week, and I'll talk about that in a little bit more detail in a minute, but I believe that the numbers were going to be a little bit better than expected, and that the positive vein that we'd seen into the number would continue. Unfortunately, what we saw was the complete opposite, and the market fell away again towards that 26,500 level before it started to rally, topping out there around 26,970, and that rally largely on the back of this belief that the stimulus would be agreed upon in Congress sometime soon, and that would give a lift to the market. Unfortunately, the numbers weren't as good as were expected. Market fell away and then bounced. The reason why I bring this up is repeatedly over the last number of weeks I tell you not to trade on the number. Unfortunately, I did. I think some of that was an over exuberance on my part, because there had been 12 winning trades in a row. So for me, the logic was that there was probably going to be a 13th and a 14th and 15th. Unfortunately, that wasn't the case, and I stopped trading fairly soon afterwards. It is important to be content sometimes, number one, with what you have. and then always ignore the number. And again, as I've mentioned in recent weeks, what tends to happen with a number is there is a reaction, as you see here, and then you see the opposite reaction as you see on this particular occasion. So you do often see this elastic band effect where it reacts in one direction and then goes off in a completely different direction fairly soon thereafter. I'm used to this, I've seen it so many times, I expect it to happen, yet I still traded the number. So that was a stupid mistake yesterday, and as you can see, the position, whilst ultimately right at the end of the day, I stopped out fairly close to the low, and one of the reasons for stopping out fairly close to the low was that it just had the feel for me, again, of Monday, the day when I was down quite considerably, nothing was working. And it had that sort of feel to it. Exactly the same thing today, unfortunately, where I'm cognizant of what happened on Monday and stopped out again. Whereas some of those trades have come back into profit at this particular point, but a little bit too late for me. So just looking at the week to date, as you can see there, 570 pips to the downside on Monday. Most of the trades from the buy side. I think if you go back over the last number of weeks and you look at my trading profile for each of those weeks, I would imagine that it's predominantly to the sell side, and that probably is a 75-25, possibly even an 80-20 split in terms of the number of trades that I enter from the sell side versus the number of trades that I enter from the buy side. So number of trades stopped out, a couple of trades in the DAX, one stopped out a little bit early, Dow a little bit early, but gold as well. So nothing was working on Monday, or I wasn't working on Monday. The belief coming into Monday morning, just looking at the data that was available and how the Asian markets were finishing off, we'd seen a fairly considerable sell-off in the markets in the weeks leading up to that, tech being decimated over the last number of weeks. So I was of the opinion that a rebound was more than likely on the cards, and that certainly is the reason for the bias. So a combination of the way that the Asian markets were closing and a belief that we were, after the recent sell-offs, going to see a bit of a buying opportunity. So trying to buy on the dips, and unfortunately the dips kept dipping and I got stopped out. So 570 points down on a Monday morning isn't a great way to start the week, but then slowly started to claw it back Tuesday, Wednesday, and Thursday. Notably on Thursday, as you can see, the last entry there, the 176 pips that would have been for that trade around the unemployment claims number. Today, 4 trades early this morning, stopped out on them all, stopped out a little bit early, and there's a question in there from Greg where I'm going to talk about stops in a minute. And then the last 4 trades that have made the loss look a little bit better. Now, no loss looks good, so I fully appreciate that, and I'll be looking to try and decipher and examine some of the things that I did during the week to make sure that they don't occur again. So there's just the overall situation in terms of, or graphical representation of the different days. 52 trades on the week, 40 of them winning trades, 12 of them losing trades. So the ratio is still okay, but too many stops on the week, and that's what I really need to look at. So 4 trades today on the stop front, back to back. For me, that's a red flag. Time to go home and not trade for the rest of the day, but done a couple of trades around the opening or the open of the US markets, and they've thankfully reduced the loss a little bit. So some of the questions coming in, questions there from Greg: as a percentage of portfolio, what would you call a small and a more typical trade size? I think it goes, or the honest answer, Greg, is it goes by experience. Number one, you need to be comfortable with it. I think people are starting out, you recommend a trade size of somewhere between 1 and 2%. probably veering towards the 1% level. I think the problem is when people are trading CFDs and retail trading is that the amount of exposure that then gives you to the market is very limited. It doesn't excite people. But people need to understand that they need to get the discipline right, and make sure that they're able to stop out on trades when they start to go against them. I think one of the negatives when retail traders are trading is that, you know, if it's not too much of a financial hit, as a percentage it is, but it's not too much of a financial hit, sometimes you think, okay, I'll let that run a little bit further, and that's not a good habit to get into. From my own perspective, my trades are in the 3 to 5% range. So for me, a typical trade is 3%. Something that I want to do a little bit more aggressively is usually 5% trade. So the opening trades that I do around the US markets are in that 5% range. And then if I'm going to take a smaller trade, it's usually 2%. So that's an answer, and it works for everybody, regardless of what your account balance is. If you work off percentages, then that's the easiest way to keep yourself safe from a trading perspective. I think people more often than not overreach. They're looking for a bigger return. The percentage risk that they take on is way out of line in relation to that. And that's why you see accounts blow up as frequently as you do. If you do keep to the percentages, you know, like even if you look at the trade in there that's in front of you, you know, there's 4 trades there today that have stopped out. Even for me, that's a maximum that they stopped out early. So you're looking at about a 9% loss on those particular trades. Fairly similar there on Monday, and an overall loss on the week, which probably comes in somewhere around 7 to 7.5%. So, you know, if you are keeping your if you are keeping your trades to a fairly regulated amount from a percentage perspective, it is one way to safeguard against blowing up your account and starting to understand effective risk management. Second question from Greg: have I a typical stop loss policy, or how do I decide when to pull the plug? The answer to that, Greg, is that the stop losses for me are fairly standard. I think the way that I'm approaching them more recently, and obviously we've seen some very volatile times. If you go back to March and April, you know, 1,000-point swings in the Dow were pretty much commonplace. You'd see that every day of the week. So if you maintain a very rigid stop structure during those particular periods, you just get stopped out all of the time. So I think the stop levels that you use has to be relevant to the market conditions at that particular time. So if you have a trading range of 1,000 points in the Dow, you know, introducing a stop of 50 points is not a clever move. It needs to be a little bit wider than that, unfortunately, to give the trade some scope to breathe. The way that I'm looking at trades at the moment is I have a fairly hard stop at 200 points in the Dow. I have a fairly hard stop in gold of 100. The DAX is somewhere between 75 and 100. The currencies are a bit smaller, around 60, but the way that I tend to approach it, so if I give you the Dow as an example, whilst the hard stop for me is at 200 points, I think at 150 I've got a decision to make. So that's the first real decision about whether you're going to stop early, or you're going to give the trade a bit more breathing room in order to try to correct itself. So I'm also very conscious of the trading week that you're having. So if you're having a fairly negative week, as I am this week, you know, it went back into profit yesterday. Unfortunately, gone back out of profit today. But if you are having a negative or a difficult week, I think you tighten up your stops immediately. But the way that I kind of look at the stop is, you know, you've got a hard limit. And then at 75% of that limit, you need to start making a decision and look at it a little bit more closely. Obviously, nobody puts stops in place for them to be triggered. You expect them to protect the trade, So at 75% of that stop limit, I like to start thinking about it a little bit more and get ready to make a decision. If the decision is this market's not turning around, it's not got the best feel about it, then I'm looking to jettison that trade as quickly as possible. Sometimes I will run slightly over that 200-point limit in the Dow, and the reason is, or more often than not, the reason is I'm having a good week and I can suffer a little bit more in relation to that trade. But if the week is tight or I'm losing money, then I'd try to tighten up that limit almost immediately. Luke is asking what time frames do I use for analysis. Early in the morning, Luke, as I'm looking for support and resistance levels, I go through all of the time frames. So I start at daily levels and then work back to 30-minute levels, just looking to see where the support and resistance is and see what sort of bias that is going to lend to my trading, along with the information that you're collating from what's going on in the markets and what's gone on in prior days. But you're not always going to trigger the levels that you're looking at during that particular trading day. So, and I've probably explained this a few times. So, and you can see it from my trading as well. I don't focus completely on the technical analysis. I am looking for at certain times of the day. So I trade a lot around the opening of the European markets, a lot around the opening of the US markets. And then there tends to be a mid-morning move which comes in between about 9:45 and 10:30, and I try to trade those areas. So it's not so much looking at the technical analysis as trading those particular time periods. And the reason for that is quite simple. If you want to make money from trading, you need a market that moves. I can guarantee to you that the market will move at those particular points. And if your bias is right and you're reading the market right, then you will benefit and make money in that particular period. I could sit here all day with 40 different charts open, looking for a breakout or for a setup that, for me, in my opinion, is perfect. But it might mean that I just trade once a day. So I am always looking to trade somewhere between 12 and 15 trades a day. That is kind of the sweet spot for me. It did turn around. I think a couple of weeks ago I did overtrade, so you've got to be careful of getting too carried away with it. But work out what your optimal number of trades is on a daily basis, where you're getting your better returns. You can look, if you use some of the charting tools that are available, you can go back and examine your trades and see which trades are more successful. So either they're the ones you do in the morning, are they the ones you do in the afternoon, and then try to work out a pattern or a play that works for you. So I do definitely encourage you to do that. There's one last question that's come in. Says, do you notice a turn in the market around 6:30 every morning from buy to sell or vice versa? You do, and I know that's an Irish spelling, but I'm sure that it's Gavin, or I hope it's Gavin. There's a lot of spoofing around that time of the morning. I think that's what you see more often than not. So different orders coming into the opening bell, the Asian markets closing. I don't think it's always constant, but there is a lot more volatility in that period than there has ever been in the past. If you go back a year and you were looking at the Dow really wouldn't move a great deal at all, but it's moving an awful lot now. And if you go back to you go back to a year ago and you look at the Dow and the DAX in that particular period between 6:30 and 8 in the morning, you might see 20, 30 pips of a movement. Right now you can see 100 movements, 100 points down, 150 to the upside. So it's more volatile than it's ever been, but it's an opportunity to make money. So I'm being told that it does happen at 6:30 every morning. It's something for you to look out for. I think You know, if you can spot a pattern quickly, more quickly than other people during the trading day. So that's why I like the US Open. I think it, you know, as the different stocks are opening, you see that initial volatility in the first 6 or 7 minutes in the morning. You can, sorry, in the opening period, and you can take advantage of it. But if you can see patterns emerging, the likelihood is that they won't last forever, because somebody else will become aware of it. And then the opportunities will start to reduce. But it is, you know, that there are definite patterns during the course of the day, and take advantage of the patterns and those periods when it moves when you can. So look, I have to leave you there. Time has run out. Hopefully that was informative, and we'll meet again next week. Thank you very much.